So first of all, Peter, to you as a Axonic head of research, you see a lot, you've done a lot. Tell us what you're seeing in the private credit space, and then also just tell us a little bit of the genesis story of Axonic Insurance. It'd be great to hear a bit more about that.
Sure, thank you, Kevin. There are many, many flavors of private credit. And making the press recently was the Blue Owl Meta deal, $27 billion, 148.48 transaction, which I think goes to show you that the larger private credit shops are looking for larger chunks because, frankly, private credit spreads have tightened quite a bit. And while you can still get in middle market lending a reasonable spread, in the larger transactions, it's very tough. And so what we've chosen to do at Axonic is try to tailor our private credit offering to market need. As everyone on this panel certainly knows, regional banks have largely exited certain parts of the lending market after the mini crisis, if you will, that occurred at the end of 2022 and early 2023. And so we've stepped into several, I call them buckets. That we have a middle market asset-backed lending business. We have a specialty lending business, which is a bridge financing business of the monetization of IP assets, for example. And I think a particularly interesting and attractive business, which we called our private investment liquidity solutions business, which are loans we make from, let's call it, $5 to $50 million to usually to wealthy individuals that have investments in private equity funds. As we all know, the DPI ratio, that is distributions to paid-in capital ratio, has fallen quite a bit. If you look at the 2018 vintage of private equity funds, that ratio is at about 0.6, down from about 0.8, meaning that private equity funds are taking longer and longer to make distributions. And so one of the areas of opportunity we see that doesn't compete with the larger private equity allocators of capital is to provide bridge loans for those individuals looking for liquidity prior to the final distribution. And I think with that, maybe I'll tee up my colleague Alexa here. In addition, Axonic has been fortunate to build an organic insurance business over the past 3 years. It was just in the press recently. We received a $210 million private equity investment from a well-known PE shop. And our insurance business is writing annuities at about $200 to $300 million a month. So AUM for that business is growing. We're retaining a lot of that capital. And Alexa is part of the team that absorbs, if you will, or cuts up the meat that my team is serving up in private credit.
Wow, fantastic. It sounds like it's been really, really successful. But yeah, over to you, Alexa, and tell us all about the story so far.
Yeah, I think an important statistic maybe to share is there are 4 million Americans retiring every year and will retire every year through 2027. So that's 10 to 11,000 Americans per day retiring. So if each of those, let's say, invest in MYGA or a fixed index annuity at 100,000, that's $400 billion that are going to be entering insurance capital coffers every year for the next 3 years. So there is an incredible rush from established players, from new players to go after that retirement capital, particularly as these younger boomers don't have savings like the older boomers have. There's an incredible rush to focus on that sector. And that's sort of the genesis behind Axonic Insurance. We have a senior management team that's incredibly experienced. We're led by Michael Gordon, who has heritage, going back decades, even in his family, working at insurance companies, and just put together a great team to focus on that sector. We operate more like a mutual than, I'd say, a sponsor-backed insurance company. We're pretty conservative with our investment portfolio. We have a significant allocation to private credit because that just makes sense where the yields are and given the compression and publics, as my colleague mentioned. And so, we've done incredibly well. We've written $2 billion in annuities in the last 18 months. It's just, good distribution, good sales, good operations, all of that's homegrown, which again are very different from other sponsor-backed insurance companies. And so the demographics are just playing in our favor, as well as assembling a team to kind of go after that market. And we just raised $210 million. So we think that the insurance sector, there's a lot of, the pie continues to grow as more and more retirees come into the pipeline. And that's just one of the sectors that we're focusing on.
And I guess in terms of what is the key differentiator between what you're doing at Axonic versus, Apollo's Athena or KKR's General Atlantic?
We're focused more on a particular subsegment of the market. We don't reinsure. We don't buy blocks from other companies, which I think a lot of what you see in the space is that other competitors are more focused on sort of the reinsurance as an element to grow their investor base, their insurance base rather. We're focused on sort of organic growth. We have 5,000 agents that we have signed up. We have distribution channels through banks, broker dealers, high net worth individuals. So we have a multifaceted approach, which I think is a little different from, again, sponsor backed, where I think they are more focused on asset gathering, really to feed sort of the investment management business and Apollo. That's just not in the DNA of Axonic Insurance.